This meeting is being live streamed. You
Righty.
good to go? Let's see. You are good to go.
Fantastic. Fantastic. All right, everybody. Thanks for joining today. Wes Gottesman here, market advisor with TradeZing. I'm also a wealth manager for a broker dealer. If you're new here, I have a webinar probably a couple times a month on Fridays, 2 p.m. Eastern Standard Time, covering a variety of topics. This one is going to be all about fixed income and who it's for, what it is, why you need it, or why you don't need it, and all the different varieties of it. So fixed income is another word for bonds, just like equities are another word for stocks. If you hear the word fixed income, think bonds. Now, what's a bond? What is fixed income? Well, a bond is something that it's an investment vehicle. It's actually debt that either a municipality or a corporation will issue, and individuals will buy those issues of bonds to raise money for something. So, for example, a municipality is going to issue a municipal bond, which happens to be federally income tax free, which is excellent. Okay, in your respective state. So, a municipality, if they're going to build a new bridge, they're going to build a new road, redo their sewer system, create a new school, they're going to issue a bond. People are going to buy those bonds. The municipality guarantees their interest rate as well as money back upon maturity. And usually, fixed income individual bonds are usually going to be more long term. And you want long term when it comes to bonds. It's the highest quality and the best interest rates are going to be longer term. When I say longer term, I mean 15 to 20-year, 30-year maturities, which is normal. Okay. So now a corporation might issue a bond as well. Those are not tax free. Those are not tax free bonds. Those are taxable bonds. So a corporation is going to issue debt to grow the company some way, purchase a new building, do whatever it is that they are going to use the money for, much like a bank. So when you put in your deposits, the bank uses your money, they give you an interest rate. It's very similar to a bond. Now, there are different types of municipal bonds. Okay. There are essential purpose, which are the best. In our opinion, essential purpose bonds are the best because the credit quality and the rating on those is going to be very, very strong because they are essential to the municipality. So an essential purpose bond, for example, like I mentioned before, would be a water and sewer bond for this, the county of Hillsborough, for example, because I'm in Tampa. So those are the best. Now, so the rating on bonds are going to be there's Moody's and then there's Fitch for the rating agencies. Okay, so there's triple A, double A, single A, A minus, triple B plus, triple B, double B. So I personally don't buy anything under A minus for our clients. A minus is the most speculative that I will go for clients. The last thing I want is for some issuer to default on all of their bonds and clients will literally lose all of their money. We had a client, this happened after the fact. She came to us to help fix it. She gave $100,000 to a wealth manager that put that money into a very risky project, I guess. And the poor older woman had no idea what she was getting herself into. We took a look at it and it was like a B minus rating, not terrible, but obviously not. It's considered junk. Junk bonds is the actual term for it. they're not investment grade. That was not an investment grade bond to place money in. Anyway, she lost 100% of her principal. Gone. Now there's a lawsuit, yada, yada, yada. It's a headache. Stick with very strong bonds if you're going to buy them individually. And that goes for municipal and for corporate. The ratings are the same. The difference between them is the tax-free status of municipal bonds, which is excellent because we have a lot of individuals, which leads into my next discussion, is why would you need fixed income? So you'd use fixed income / bonds for income replacement, right? So a lot of times these bonds will pay monthly. And for somebody who's in retirement, they no longer have income. These are excellent, especially if you're able to get 4%, 4.5% tax free. That's amazing. Okay. So we have clients that are in retirement, not working. 100% of their income, besides maybe Social Security or something nominal, comes from their tax-free bonds, and they pay zero taxes on it. It's an incredible, incredible way to increase your income or substitute it or add to it. So that's one reason why you'd buy them. Another is for protection. They are naturally very conservative, okay, depending on the bond. You get your principal back at par. Okay, so this is another thing. So bonds are offered at various prices, just as if stocks are, okay? So, but the bonds, the day that you buy them, they're not going to change, okay? So if you buy a bond at par, par is $100 per bond, okay? It's going to mature back at par. Even better if you buy the bond at a discount. If you buy the bond at $98 a share, you wait to maturity, now it's at 100. Not only do you have a capital gain, but you've been receiving interest all these years. So that's awesome. You buy a bond at a premium, let's say at $102 per bond, and it matures back to 100, you have a capital loss, but your income will have been a lot higher throughout the life of the bond. Now, why would someone buy a premium bond? So if someone's buying a premium bond, the coupon or the yield might be very high on that. And what you can do with that is you can do something called a bond swap. So you can swap it out for a very similar bond. Can't be like a municipal bond to a corporate bond or a corporate bond to a municipal bond. It has to be the same type of bond, and you're going to want it to be very similar in yield. Okay. So there's ways to get around that so that you end up making money or receiving all of your principal back at the end of maturity. So that's one thing about it. I'm trying to figure out where I was going with that. Oh well. So anyway, you're going to want to buy bonds either at par or at a discount. In our eyes, it's the best move for someone who is just starting out in purchasing bonds. That's the best way to do it. And now there's also portfolios that myself and my father that we build out together that are called either like a barbell bond portfolio or a bond ladder. So you ladder them, kind of think of like steps in a ladder in a way where you've got a bond maturing and then another one's being purchased. You got a bond maturing and another one being purchased consecutively without really having to do anything. A barbell is when you have short maturities, money coming due, long maturities, money coming due, and then another short maturity, money coming due. So That's what a barbell is, and they're for different individuals. So that is the ways that we use some ways that we use bonds. Okay. And like I was saying before, you have to be very careful about the credit quality when you're purchasing them. And if you're not an experienced bond trader, picking out the right one might be a little bit difficult. You can, however, without having to buy individual bonds, you can purchase bond funds. So mutual funds that invest directly into bonds, or ETFs that invest directly into bonds. You can do that. So the nice thing about those is that, one, you have a team of portfolio managers that have, a very long tenure that are going to be picking out bonds for you to achieve a certain level of income, right? So the thing with those is that there's no maturity, and you don't own that bond. You are just benefiting from the returns of it. Okay. And so, but if you also have to keep in mind that there are different types of bond funds. Like there's high yield bond funds that are very interest rate sensitive. For example, when interest rates go down up, the value of the bonds goes down. When the interest rates go down, the value of the bonds go up. So you have to be very careful with high yield, but you can purchase like a very stable value bond fund, or a municipal bond fund, or a short duration, mid duration, long duration. There's so many different kinds out there. You do not have to be a bond expert to be invested into fixed income. Okay. Some of the managers, the asset managers that we utilize to do our bonds, or to do our bond funds, for those that we don't pick out ourselves, because some individuals are a little hesitant about individual bonds. They prefer to have bond funds, which is fine. We utilize Lord Abbett Asset Management. We utilize Allspring, American Funds, which is Capital Group. There's so many out there, and you can't go wrong. They're all very good. Just make sure that when you take a look at the underlying bonds that they have within the fund, that there aren't too many speculative ones, because the speculative bonds, although they yield the highest, they're still speculative, and it's not on you. You're not going to lose your money, but the manager might have a tough time regaining some returns or interest, something. So just be mindful of when you are picking out bond funds. Okay. And earlier I mentioned interest rate sensitivity. Okay. So bonds are interest rate sensitive across the board. Some are even more so. High yield, think interest rate sensitivity. So when I say interest rate sensitive, I mean, let's say that I've had clients in bonds for years. Okay. They've been, their maturities are probably another 10 or 15 years from now. Okay. Interest rates have been going up. If you've been reading and just being alive, you know that the interest rates going up. When interest rates go up, bond values go down. The value of everybody's portfolio is down right now, which is fine because they're still getting their income. The income's guaranteed. When interest rates come back down, bond values are going to go up. Okay. So right now, if you were to get into bonds at this moment, you're going to be getting them, one, at a discount, which is great. And two, you're going to be getting them at a high yield, which is awesome. This is what we want. So in the next couple of years, when the interest rate comes back down, everyone who's at a discount, their bond values are going to go up above par, above where they bought it. One, they're going to be at a capital gain. Two, they're going to be locked in at a high interest rate. So that is excellent. I think it's one of the first times in the past 20 years that that you will be able to receive a total return on your fixed income, meaning total return, interest and dividends, in this case, interest and appreciation of the actual value of the asset. So everyone whose bond values are down, as the interest rates come back down, their bond values go back up to par and hopefully exceed. So that's one thing that you have to have a stomach for when you're going to be investing in bonds. And you have to remember why you bought them. You bought them for the interest, not for the capital gains. You kept it for the capital preservation, okay? Because you're going to be getting all your principal back. You just got to wait it out. We are naturally emotional investors. It's my job to take the emotion out of the investing. Don't get me wrong. I don't like seeing red days. I don't like seeing fluctuations. I don't like it just as much as you guys do. Don't. However, I know that there's always going to be, the grass is greener in the future. There will be opportunities. Everything will eventually go back up. And now, so that was bonds, fixed income. Something that's been popular recently, if you've been keeping track of the interest rates, CDs, certificates of deposit, those are considered fixed income as well. You can get a 1-year CD right now. It's paying 5.5% for a year. I mean, we haven't had that in a long time. I guess they were up to 5.7% at one point. So one, you got to make sure that they're not callable. By callable, I mean the bank can say, oh, okay, well, we're going to give you this CD, but April of 2024, let's say you bought it, it's a 1-year CD, you bought it today, today is November 10th. It matures November 10th of 2024, but it's callable in May 2024, April, whatever. The only reason why they would make it callable is if the interest rates come down. If the interest rates come down, banks are going to call those bonds back, or the CDs back. Some banks offer non-callable CDs. We've been buying those for people. So fixed income, you're getting a fixed rate of return, which is an interest rate. Principal is coming back to you at net maturity. That's pretty much everything that you would need to know about it. Sorry, phone's blowing up here. But yes, so fixed income. And now you can mix fixed income in. I know we've spoken about this before in other webinars, but you can mix bonds, fixed income, in the same portfolio as stocks. Stocks are going to provide some upside potential. Bonds are going to hedge and be a little bit safer and provide current fixed income. So that's what that's all about. Just to reiterate, you can buy corporate bonds, you can buy municipal bonds. Municipal bonds are tax-free. Corporate bonds are taxable. If you're going to put them into your IRA, IRAs are already tax-free. So you're not going to put a tax-free vehicle into a tax-free account. So you'll put corporate bonds into your IRA. You'll put municipal bonds that are tax-free into your regular taxable account, tax-free. Essential purpose municipal bonds are the best. Don't buy anything less than A minus. Trying to think of anything else that's important information. Yield to worst. When you see YTW, that means yield to worst. That is the worst possible yield that you can receive on a particular fixed income product. Okay. A yield to worst of 3.5% is really not that bad. Even 3%, not bad at all. We've had yield to worst that are like 5%, or not 5%, like 4.5%. And so one thing that you can always take a look at, if you're not too familiar with what a good yield is, there's something called a taxable equivalent yield. So a taxable equivalent yield is if you were to buy some stock and whatever the yield is on that, right? Let's say it's dividend yield. Let's just say they're giving back 5%. Okay. So on a tax-free bond that's paying 4%, the taxable equivalent to that would be like somewhere in the 6.5% range, which is really good. that's a good bond to buy. That's always something good to look at is the taxable equivalent yield, the yield to worst. Yield to maturity and yield to worst are usually the same. Yield to maturity just means upon maturity how much you would have received, not only in price appreciation, so if you bought it at a discount up to par, but also taking into account your interest rate. So I know that was a lot. I would love to answer some more questions on those if there are any, because there's so much you can do with bonds and not have to pay any taxes on the income you receive from it. I mean, we legitimately have clients that are making $300,000 a year on their bonds and paying $0 in taxes. It actually reduces their tax bracket, which is even cooler. I could go on, but might get a little go over your head, might get a little dry. So if there are any questions that you have, you can reach me on TradeZing at Wes or on Instagram at the Wes Gottesman. I'm happy to answer any and all questions. I hope that you all have a wonderful, wonderful rest of your Friday and a wonderful weekend. A minus bonds at the minimum. Okay, don't buy junk. Don't buy speculative bonds. Buy American bonds. All right, everybody. Have a good one. Bye-bye.